transition, I'd like to ask you guys the same question, but in a different way. So Jeff, I want to ask you, what should experienced real estate investors with a large portfolio be doing in the next 2 weeks, 3 weeks while they're at home in quarantine? And Greg, I want to ask you the same question, but for new investors, what should they be doing? So Jeff, why don't you start off with the investor that's got a big portfolio?
Big portfolio, medium portfolio, still trying to get a portfolio, medium portfolio, whatever you are. If you're a beginner, builder, ender, whatever it is, this is what I want you to do. Number one, take inventory. What do you have? What do you owe? What's your cash flow look like? Look at all the places your cash is coming in from. Look at all the places that your cash is going out to. Pay attention to all of those details. Then the next thing, and this is really important, is take inventory of your skills. Some of us are great at structuring deals. Some of us are great at finding deals. Some of us are great at finding buyers. Some of us are really good at managing property or managing crews or whatever. Know what your skills are, and then look for other people that can complement your skills, because your network is going to become your net worth in the next 12 to 18 months. We're going to be looking at some opportunities that we've never seen before. We're going through something we've never seen before. Greg, I want to talk about that with you in a little bit, because you and I both been around the block a couple of times on this stuff, but this is something we've never seen before. But you've got to know take inventory, know what you've got, know what you have to work with, because there are going to be opportunities to help people. In the next 2 weeks, right now, it's keep people safe. It's make sure people have got food. Okay? Yes, if you've got a tenant that's low on food, you can leave a bag outside their door and not even see them and keep social distancing. You may need to do that. Okay? That will go a long way.
Great advice for sure. Greg, anything you want to add to that?
Yeah. So if you're a successful investor with a portfolio, what I would be doing is looking at your assets looking at which one of your assets you can let go. Like you don't, unless you're right. Most investors that I know with substantial portfolios don't have a loan to value at 30, 40, 50%. If you do, if you own, 50 houses and, the combined ARV is, let's say, I don't know, 10 million or more, and you only owe a few million, 3, 4, 5 million, you're probably in good shape. But you probably have some assets in there that you could sell, because right now is still a decent time to sell. If you have assets that aren't in your sweet spot, what is a sweet spot? I want to talk about this concept, because I think over the next 12 to 18 months, sweet spot is going to be essential. So a sweet spot is an area of your town, your metropolitan area, that people are moving into, not out of. Okay, the sweet spot is going to be your main areas for investing. If I look at Northeast Ohio, there's hundreds of zip codes that comprise Northeast Ohio. We probably only invest in about a third of those zip codes. We invest in the better areas, the areas that people want to live. A college-educated person, right, like the suburbs in Cleveland. Okay, me personally, unless you're built to invest in the inner city, that's a specific business model. You can't. I don't know many investors that invest in the inner city, in the first ring suburbs, and then the second ring suburbs successfully. People have sweet spots. I have a good friend who owns many restaurants and bars downtown Cleveland, who only invests in the inner city. He won't invest in the suburbs. But for him, the certain zip codes in the inner city are actually, gentrified areas. People are moving into them, and real estate values are going up, right? So he's comfortable there. For me, I wouldn't be comfortable investing there. I'm comfortable in the suburbs where people are moving into, not out of. I think that's the biggest thing. Where the average days on market isn't super high, where houses sell pretty quickly. So if I'm an investor with 50 properties, I'm going to sort of get rid of my properties that over the last 5 or 10 years, maybe, I've accumulated these houses. I'm going to sell some that I've accumulated that are outside of my sweet spot. because maybe my sweet spot has evolved over the last few years. But I'm not going to freak out either. I think people are.
Don't freak out. Don't freak out.
Waiting for. I mean, there is going to be more cash flushed in this market than we've ever seen, right? I mean, 3 weeks ago we were sitting on the best economy in a generation, and then this virus hit, and now they're pumping $2 trillion, maybe $6 trillion into the markets, and they're not just giving it to big corporations, right? They're giving it to big corporations, small businesses. They're giving it to individuals. So this is completely different than 2008 or 9/11. So there will be short-term pain and long-term pain for a small segment of the market, okay? But the general market, I think if you're an investor, don't freak out. Just relax, take a deep breath, and evaluate everything. Do everything that Jeff just said.
Okay, Jeff, anything you want to add before we start with an investor that's just getting started or maybe just done a deal or two?
I would wholeheartedly agree with what Greg said about don't freak out. This is a time to really sit back, look at what you have, to use what you have to get what you want, to get what you need. Think that stuff through, okay? I mean, I could explain it in long detail, but I don't want to go down a bunny trail here, but let's keep moving.
Yeah, so Greg, same question, like I said earlier, but for a brand new investor, what should they be doing in the very short term, like in the next 2 weeks?
So don't freak out. Number one, if I'm a brand new investor and we started the call talking about how, existing businesses can get stimulus money, I might be like, holy crap, I missed the boat. Like I can't believe I should have, I'm so stupid. I should have did this 6 months ago, a year ago. That stuff is a drop in the bucket compared to what you can do the next 12 to 24 months. So if you've not done a deal yet, again, spend right now, the next couple of weeks, becoming a better investor, just learning more about real estate investing. We unlocked every course, and we're actually updating a lot of these courses right now as we speak. But we've unlocked like 6 courses inside of Realeflow for all Realeflow users. Spend time during the day, into the evening, absorb, consume all that content, okay? Then what you have to do is you have to develop a business plan. You have to have a plan. Your plan can't be one of hope. Hope cannot be your plan. You can't hope you're going to do a deal. You have to make a commitment. If you're on this call right now and you're sort of interested in what we're talking about, that's great. But interested people never do anything, right? Committed people do things. Committed people are the people that change the world and really are going to be the people that help get this economy back on track. So you need to make a commitment, internal commitment that, yes, I am going to do this. I'm not going to sit on the sidelines like I did 20 years ago or in 2008, 12 years ago, and see what happened and miss this large opportunity. You have to, just make a commitment to developing a plan and then executing that plan. And you didn't miss anything, right? It's not like the cryptocurrency market, the price of Bitcoin, or the stock market. The real estate market doesn't do this every day, right? You're not looking to buy here and then sell up here. The real estate market is very, in certain markets go up, drop down a little bit, but we're not looking to buy properties at 5% off. We're looking for opportunities, properties that need work, that we can put some sweat equity into, that we can purchase, as a rehab, a renovation, or a rental. So we're looking to purchase things still at 30% or more below market value, what the ARV is. But there will be opportunities. So develop that plan.